Welcome back to Morning Markets on Thursday, the 17th of June. George Bell here, investment analyst, to provide an update on key market moves and economic events over the last 24 hours. Quick rundown of the markets. In the UK, you had the FTSE 100 up 17 basis points. In Europe, 23 basis points, but over in the US you had the S&P 500 down 54 basis points, Nasdaq down 24 basis points, and that washed through into Asia and Japan. You had Asia off just over 0.5%, in Japan around similar levels. One of the most significant moves of the day was seen within the US Treasury bond markets. The yield on 10-year Treasury bonds rose 9 basis points, so it went from 1.49% to 1.58%. That was in response to the forward guidance provided by the Federal Open Market Committee, or FOMC, following 2 days of policy meetings. This led to a wider reaction. We saw a stronger US dollar, up around 0.8% on a trade-weighted basis, in the S&P 500, as I say, down around 0.5% on the day. There's two aspects to highlight here. What was the outcome of the meeting and why did markets react this way? Well, starting with the outcome, the Fed left the target rate of interest rates at 0 to 0.25%. Their bond purchases under the current quantitative easing program will also remain at a rate of $120 billion per month. That's split around $80 billion on treasuries and $40 billion on agency mortgage-backed securities each month until, as they say, substantial further progress has been made towards the committee's maximum employment and price stability goals. Both factors were anticipated in advance of the meeting. So why did markets react the way they did? Well, one was the revision of the dot plots. These provide a gauge of members' assessment as to what they deem to be an appropriate interest rate at a given point in the future. On the chart, we can see in 2021, there's an expectation of no change, but the views does start to shift as you move out to 2022 and 2023 and beyond. For context, 13 of the 18 officials voted in favour of at least one increase by the end of 2023 versus 7 when the snapshot was taken back in March. 7 of the members are also expecting at least one rate hike by 2022, up from 4 members when the snapshot was taken back in March. The dot plot does, however, demonstrate big dispersion in the views, especially as you look out to 2023. The reasons for the revision, well, one was economic growth. Progression of the vaccination and strong policy support has been leading to more bullish expectations of economic activity and employment and growth. The GDP expectation was revised up to 7% for 2021, up from the expectation of 6.5% back in March. Inflation is a hot topic in markets at present. The bond market has been testing the Fed's tolerance to withstand rising inflation levels against their flexible average inflation target, or FAIT. This is an approach which allows for periods of overshoot above and below their 2% PCE target, given we've been in a low inflationary environment. Chairman Jay Powell did try and moderate expectations during the press conference. We re-emphasised the view that the current examples of higher inflation, we discussed inflation rising 5% year on year in May 2021 on Morning Markets last week, are viewed as transitory. They're reflecting the bounce back in the areas which were more challenged through the pandemic and supply chain bottlenecks, cautioning that the dots should be taken with a big grain of salt, and discussions around the topic of raising rates would be highly premature. Thank you for watching. We look forward to bringing you up to date tomorrow on Morning Markets.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.